What are SIPs? How do they benefit you? SIP stands for Systematic Investment Plans. This is a common way to invest in mutual funds. SIPs teach you discipline, planning and organization. You will see how as I walk you through this video. The simplest way to understand SIPs is to imagine a child and a piggy bank. In this analogy, a child deposits a certain amount at certain intervals, and before she knows it, the money in the piggy bank has built up to a respectable amount. Similarly, in an SIP, the investor deposits a certain amount at certain fixed intervals, which builds up over time. The amount can be as small as 1000 rupees and the time frame can be weekly, monthly or annually. One important difference between your SIP and your piggy bank is that when you put money in your SIP, it is not dormant. With an SIP, you are investing in a collection of businesses which are handpicked by a fund manager. With every periodic investment, the amount being reinvested keeps growing, which means that the returns will increase simultaneously. SIPs help you beat the volatility associated with equity markets' ups and downs. SIPs give investors an option to invest during different market cycles. The cost per unit is averaged out over the investment horizon. More units are purchased when the markets are low to compensate for units purchased when it was high, and can be sold when the markets are back on track. SIPs help achieve superior returns compared to lump sum investments. SIPs take away the need for timing the market and helps you multiply your wealth intelligently and efficiently. This method takes away the need for you to monitor the market closely. It helps build the habit of saving frequently. The same method is to be adopted for the stocks you buy after learning the step-by-step methodology to pick good quality stocks. There is a difference between the SIPs in mutual funds and stocks. When you do an SIP in a mutual fund, you are investing in multiple companies at the same time. When you do SIPs in stocks, you invest in a few selected companies, while SIPs in mutual funds give you the benefit of diversification. SIPs in stocks help you bring about the concentration required in your portfolio. Mutual funds are subject to risk is a commonly heard phrase. This means your SIP investment can end up with lower value depending on how the market behaves. The risk of volatility in the returns is inversely related to the holding period in a good quality investment. The longer the period, the lower will be the risk and vice versa. One of the primary advantages of SIPs is rupee cost averaging, which eliminates the need for investors to time the market. Stock SIPs allows investors to park a small amount in stocks at regular intervals. Following this path, the investor would not need to time the market, invest through a regulated approach, and protect themselves from volatile stock price movements. And you can certainly use SIPs for achieving your financial targets. So let us say you have a financial goal of building your children's higher education fund. You want to create a corpus of 50 lakh by the age she turns 18. If you have 12 years to reach this goal, you will do SIPs of 18,500 rupees per month if we assume 10% return per annum. Use the wealth creation formula or the power of compounding formula to calculate how much your SIP amount needs to be. When you are young, your risk-taking ability is much higher, and so you can have a much higher allocation towards equity. Young investors have a long holding period and can afford to give more time to their investment. As one comes near the goal or retirement, the risk-taking ability also reduces. For now, it is better to invest in SIPs and persist month on month. Before deciding on the SIPs, it is important to understand the asset allocation you want to keep. Make sure you use the net worth sheet and the financial planning sheet to figure out the asset allocation or asset weight. Always remember, diversification is important. As shared in the net worth sheet, your asset allocation in equities can be 90 minus your age. How are SIPs taxed? SIPs in equity schemes carry the same taxation as equity stocks. That is 10% long-term capital gains tax for investments beyond 12 months and 15% short-term capital gains tax for investments less than 12 months. Each installment of SIP needs to cross the 12-month threshold to enjoy the LTCG. Dividends from equity schemes are added to one's income and you have to pay tax accordingly. Mistakes in SIP planning. Some mistakes are made by our money gymmers, so I am pointing them out here. Number 1. Some investors continue to look at market conditions before investing, or they stop their SIPs when they see a market correction. Such reactions do not work in the interest of investors and affect disciplined investment approach. Stopping your SIPs hamper the growth potential of your investments through SIPs. It is important that you keep your patience as you invest in regular intervals. Number 2. Many investors go overboard and stick to a particular asset class like fixed income. This doesn't work. As explained in the net worth sheet and the financial planning sheet, you need to focus on a plan to allocate money to equities, fixed income, savings and gold. Number 3. When selecting mutual fund schemes, investors tend to get biased by past returns. This is not the only measure to look at. As explained in the step-by-step methodology to pick good quality mutual funds, make sure you use the entire methodology and take an objective view before committing your hard-earned money. Must knows about SIPs. Best time to start investing in SIPs. The sooner the better, due to the positive impact of compounding. There is a famous saying which goes, the best time to plant a tree was 20 years ago. The second best time is now. Minimum and maximum investments. Minimum investment in SIPs is rupees 1000 to as high as you want it to be. The chosen amount must be available in your bank account on the SIP investment date. The frequency of the SIP can be decided by the investor, like a weekly, monthly, offered by the fund house. Fluctuating market conditions. Market conditions will not negatively or positively affect your SIPs, as if the NAV, net asset value, is high one month, the number of units purchased may be lower and vice versa. Risk. The inherent risk involved in mutual funds comes from the investments that the fund house makes. And this is why it is critical to understand the portfolio of a mutual fund. This is why we look at how well diversified the portfolio is. Is there enough concentration, quality businesses selected, and more. Start and stop. The recurring amount being invested cannot be reduced or increased. You have to stop that SIP and start a new one if you want to increase or decrease the amount.